What is going on, guys? Good afternoon. It's your favorite mortgage lender, Abdel Kawatmi, Got Mortgages. Happy 2025, our first market update for the year. We have got quite a lot to talk about. How did the end of the year wrap up in terms of interest rates? What do we have going on? We know that the Federal Reserve went ahead and changed their stance at their last Fed meeting, which obviously caused a little bit of uncertainty. I don't have the capacity to share my screen today, so we're going to keep this as interactive as I can and really try to go over what some of the data that we got last week, how the employment market is doing this week, and really try to see and get a firm idea as to what we're expecting in terms of interest rate and the market really as we start heading into the year. Okay. So, with that being said, the first thing that I want us to kind of take a look at is what is happening when we talk about the employment market. The employment market is obviously something that has been something daunting on the Federal Reserve's mind. We know that they are mainly looking at predominantly, they don't want us to run into a position where they have to necessarily cut very quickly, but they also want to make sure that when it comes to interest rates and the environment and things like that, they're not running into scenarios where the rapid unemployment rate ticks up, and then we run into obviously issues of what affordability and concerns are, right? So we take a look at pending home sales. Pending home sales obviously is up alongside with home price appreciation. Home price appreciation is critical. Remember, the whole goal when a consumer purchases a home is for the value of it to jump up. And values are up 6.9% year over year, which is phenomenal, which again goes to show you the power of real estate and the power of purchasing a home and the investment portfolio, obviously, that comes with it, right? Another important avenue that I want us to take a look at too is right now the interest rate market is testing an important ceiling. I think we will certainly see some positive notes as we head into the Bureau of Labor Statistics report. Today, the ADP report came out, again, under expectations, which is great. We'll get some updates on weekly jobless claims. We know that weekly jobless claims obviously had diminished, which is great. Continuing jobless claims is up simultaneously, which is again showing you the just the stubbornness of the employment market. Case-Shiller Home Price Index, again, another record high, once again showing an uptick almost 4% year over year when we talk about home values, and really just the importance of how that starts to factor in with the market. Unemployment, once again, slightly skewed after the holidays, right after Christmas. But once again, showing that we saw 70% of stores essentially shut down. With 70% of stores shutting down, what do you think is going to happen to a majority of the other people who obviously were let go? They are going to need to file for unemployment, and we're going to eventually start seeing that start to trickle in with that data starting to impact the employment market. Okay. So, something that is critical to see, another important part is going to be the personal consumption expenditure report, the PCE report. We know that when it comes to the PCE report, we're going to be replacing data from 12 months ago. That data that we're replacing from 12 months ago was actually really high. It was just shy of 0.5%. When we replace that data, that's going to show you the target for inflation. They want to be at 2%. If we continuously get there, right now we're at 2.8%. So inflation continues to go down. That will obviously be helpful for the interest rate market, and that'll simultaneously also maybe change the Fed's position. 14 of the 19 Fed positions essentially say that they only want to cut 2 times. If unemployment tends to tick up, which I'm a firm believer in it occurring, we're going to shock 14 members. If unemployment tends to get to close to 4.6%, where it's at 4.2 right now, we're going to shock 19 Fed members, which I think is more than likely going to occur, leading to a minimum of 3 to 4 Fed rate cuts, which is obviously going to play a direct impact towards the 10-year Treasury yield, reducing the spread between the bond market and the Treasury yield, making interest rates that much more attainable. I shot a really short video on this where I think it's going to be accomplished and some of the major factor and the major points that we're going to see. Appreciation is up. Home values are up. Interest rates are remaining stubborn, but they will continuously reduce. We're having a phenomenal month this month already, and clients are understanding that interest rates are slightly stubborn. They're understanding the market environment and the points and displays of action that we want to partake. and they're taking advantage of the opportunities, making it obviously a lot more easier to accomplish. Okay. So many different things that I want us to make sure that we're staying on top of. Again, we will take a look at how the market starts to transition heading into the year. Friday will be a major data report when it comes to the Bureau of Labor Statistics. Okay. That always tends to obviously be a big market mover. We'll get the QCEW, which is the quarterly consensus expenditure, and that will also show us how the market, we know they were off by almost 800,000, then it got renewed for the following quarter at 1.1 million. Eventually something's got to let up, right? So luckily the bond market today took a little bit of a beating, but quickly rebounded after the ADP report, and we had the obviously auction that we had with the 30-year auction. So when we take a look at obviously all those that come into play, what is it truly going to take for the employment market to obviously reduce, right? And we know that we got some of the Fed minutes earlier, which again is important to digest. I haven't personally pulled into it yet. I'm going to imagine with the market rebounding a little, that was obviously a positive note. When it comes to the ADP report, which we got earlier today, 122,000 jobs were created, weaker than 140,000 that we were expecting, which is great, right? Again, unfortunate for people who there's less jobs that are obviously out there or less jobs opportunities. We also know that the quit rate, where consumers obviously are looking to quit their jobs as of yesterday, have slightly ticked down. Higher rate is simultaneously also going down. And then we're also seeing at the same time where Fed Chair Waller had essentially said that they're looking to basically stall. True inflation has essentially stalled at the Fed's 2% target, okay? Which again gives the confidence that inflation is slowing down, right? That's what we want. Now, they do see obviously recently some slow progress when it comes to inflation and slowing down, reducing the policy. But once again, they did specifically say that they believe that inflation will continue to make progress towards the 2% goal over the medium term, and further reductions will be appropriate, as they said, word for word. Very important stuff for us to look at. We're really targeting that important ceiling when it comes to the 10-year treasury that has a direct impact towards mortgage bonds. So obviously we'll see how those direct correlations impact the interest rate market, and we'll take it from there. I appreciate you guys jumping on. As always, we will share this on our site. If you guys have any questions, please feel free to reach out. Have a wonderful day.